Hi again. In this video, we're going to continue discussing the accounting equation. Let's take a quick overview of what we talked about in the last lecture. The basic accounting equation is assets equals liabilities plus owner's equity. And equity is influenced and changed by the activities of the company. Equity is decreased when the owner withdraws assets from the company. Earning revenue will increase the equity, and incurring expenses will have the effect of decreasing the equity. Therefore, the expanded accounting equation is assets equals liabilities plus owner's equity minus draws plus revenue minus expenses. That expanded accounting equation is the foundation for recording all business transactions. So it's important that you memorize the equation. There's not a lot I'm going to ask you to memorize in this class, but memorizing the expanded accounting equation is very, very important. Please take some time to memorize assets equals liabilities plus owner's equity minus draws plus revenue minus expenses. So let's expand on that and say, well, then what are assets? We found the definition on our last recording to be assets are resources owned by the business that will benefit a future period. Let's look at some examples of assets. Cash, accounts receivable, supplies, inventory, vehicles, office furniture, computer equipment, land are all examples of assets. See if you can think of some more assets that a company might own. What about liabilities? Well, we saw in our last recording that liabilities are creditors' claims against the assets of the company, which is the same thing as saying the debts of the company. Let's look at some examples of liabilities. Accounts payable, notes payable, wages payable, taxes payable are all examples of liabilities. Notice that the liability account titles all have one word in common. That's the word payable. Payable means I got to pay that bill. It's going to be due in the future. I'm going to have to use some asset, probably cash, to pay off those liabilities. They're payable. They're debts of the company. In a sole proprietorship business, which we're talking about in this class, there is only one equity account, and that's the capital account of the owner of the business. In this example, the owner is Thomas Eli, so the capital account title is referred to as T. Eli, capital. If it was Sam Smith, it would be S. Smith, capital, or Sam Smith, capital. In a sole proprietorship, the owner can freely withdraw cash or other assets from the company. There's no penalty for that as long as the transaction is recorded properly. So the draws category has only one account, and that would be the owner's name, withdrawals. In this case, T. Eli, withdrawals. The revenue account titles would depend on the type of business in which the company is engaged. For instance, if I earn my revenue by doing consulting, then my revenue account title might be something like consulting revenue or consulting income or consulting fees. If there are other kinds of fees I earn, maybe the revenue account title would be fees income. Maybe I earn revenue by performing services. In that case, the account title might be service revenue. Or maybe my business sells products to customers. In that case, the revenue account title would be simply sales. Expenses are incurred in order to earn the revenue. We aren't going to stay in business most likely unless we incur some expenses. It may be necessary to hire employees. Therefore, we might have some rent or some wages expense. Maybe we do have to rent an office space for the building and the business. That then means that we would have rent expense. Businesses frequently have to get insurance, so they would incur insurance expense. And paying telephone and electric bills would incur telephone expense and utilities expense. I'll bet you can think of a whole bunch more expenses that must be incurred by a company in order to stay in business and earn revenue. When we come back in our next video lecture, we're going to practice recording business transactions. That's all for now. I'll see you next time.